Doomsday is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a financial apocalypse looms over the banks as ratings downgrades are now threatening to trigger the next big crisis. And we're already hearing from one big bank CEO that there's going to be collateral damage from this and the potential of more bank failures. And we're seeing this going to come from an unexpected source. This time, the rating agencies are going to uncover what big problems lie in the bank balance sheets in terms of commercial loans. But will this keep central bankers from raising rates? Well, we're already hearing from one big source that they're about to raise rates even more. Let's over to CNBC, where we picked today's story up with a headline. Jamie Dimon warns souring commercial real estate loans could threaten some banks. And commercial real estate is the area most likely to cause problems for lenders, he said. And we know this is coming. And we've talked about on the show how there's a massive amount of commercial real estate loans sitting on bank balance sheets, and it needs to be refied because these aren't like your traditional 30-year mortgage. These are a lot of balloon loans. They're rather short-term in nature, and they have to be refied. And we already know the banks are upside down on them. Even worse, we know that demand for commercial real estate has been plummeting. We know that rents are actually going down in this space, and is all setting up to be a major crisis, as Jamie Dimon here is pointing out. There's always an offsides, he said. The offsides in this case will probably be real estate. It'll be certain locations, certain office properties, certain construction loans. It could be isolated. It won't be every bank. And there's a good reason. I'm going to show you here in a moment why he's saying it won't be every bank. And you can almost kind of gather that it's not going to affect his bank at all, because it's going to affect a whole lot of other banks that we don't want to see fail. There will be a credit cycle. My view, it will be very normal, he says, with the exception of real estate. He says, for example, if unemployment rises sharply, credit card losses might surge. And of course, we're starting to see that he's a little concerned about that. But separately, he said, especially the smaller banks, those will be most affected by the industry's recent turmoil. They need to plan for interest rates to rise farther and higher than most expect, which is interesting because you take a look at things like the yield curve and you're seeing inflation come down. And here we're seeing from Jamie Dimon say rates are headed higher. It kind of makes you wonder that if his bank is too busy selling shorts on the bond market to his hedge fund clients and taking the long position on the other side in a hopes to drive rates up, because it appears that we're getting very, very close to the end of the Fed rate hike cycle. And one of the reasons we're going to likely see more banks fail if the Fed continues to drive rates higher at a time when we're going to see a lot of commercial real estate loans come due. Well, it's simple. Take a look at this chart here. What do we see in red? These are real estate loans at all commercial banks that are small domestically chartered banks, against the ones in blue. This would be Jamie Dimon's JP Morgan. This is large commercial banks. And look at this. You can see these small banks have a mountain of exposure to commercial real estate loans, and they're already hamstrung. They're already, as we talked about in the show the other day, going back to the Fed, borrowing more money. They're losing assets. This is a huge problem for them, and all of a sudden they're going to be facing a huge wave of refinances on this commercial real estate space, and it's going to expose a lot of problems. But luckily, the rating agencies are telling us that they're going to let us know ahead of time. As Fitch Ratings downgrades loom for the U.S., banks significantly exposed to commercial real estate loans. What they're noting is that they're explaining in the report that assuming a hypothetical stress loss rate of 20% for these loans, about double the 9.8 average 9-quarter loss for commercial real estate per the 2022 severely adverse test. This results in about $145 billion of cumulative losses, or 8% of the sector's tangible common equity. So you start to think about, could banks survive it? Do some of these small banks that are sitting on a bunch of commercial real estate loans have the ability to absorb these losses? And we can already probably guess they don't. And the problem they face here is how banks are going to work through their maturities and renewals. As the phrase "over time" troubles me, he says. How long? When will the defaults start happening? This could well lead to market volatility. It's not it is going to lead to market volatility, because we're already seeing signs of stress in that space. We're going to look at that deeper here in a moment. But another key reason to watch commercial real estate loans is that a significant amount of these loans underwritten in 2018 and a few years prior to are then due this year. Interest rates are much higher now as they were those years, and about 46% of commercial real estate loans mature this year. If you could only imagine, here you have this loan, you're going to see interest rates rise, you know it's coming due, you're seeing demand in your building decline, you're seeing people move out, you have open space, you can't lease it, and all of a sudden you've got a huge problem on your hands. And here we can note that what do we see? That the delinquency rate in commercial industrial loans against the total commercial industrial loans, really, we don't see it in this chart here, because on a year-over-year basis, what do you know? Commercial real estate loans tend to start slowing down as you head into a recession and through a recession where they finally contract. We kind of saw them slowing down going into, of course, what we know is a pandemic, but was already looking like a major slowdown headed into a recession. And what do we know, just based on the data we get from the St. Louis Fed, that the delinquency rate really only popped during the global financial crisis and really hasn't done much since, kind of suggesting that maybe commercial real estate here is a safe haven. But the question is it? Well, I don't really think so at all. Here we can note the net percentage of banks tightening standards for commercial industrial loans to all size firms. This is in blue. Remember, anytime this blue line goes over that horizontal black line, whether it's going up or down, as long as it's above the horizontal black line, banks on net are tightening lending standards. Again, here we have the delinquency rate in terms of percentage, and we can note that going back into the late 80s recession, early 90s, yes, we saw delinquency rates were high. They didn't really move much during the dot-com bubble. Delinquency rates shot up during, of course, the global financial crisis and marginally moved again during the pandemic. Of course, we can also argue that a lot of the fiscal and monetary stimulus helped offset that. But what you can kind of see from this chart is that perhaps there isn't a major problem here, that maybe commercial real estate is really a safe haven. Now, the question is, do you believe that? Is that how you view commercial real estate? Do you think it's a safe haven, or do you think this time it's going to dump? Because what we can note is a lot of investors are trying to get out. They're trying to get out quickly. They're stuck in some of these non-tradable REITs, and they're telling us that they believe the real estate market's going to fall. But one thing that shouldn't be falling, well, that's your trading account. Because our CTA-Timer Pro here, we note that looking at the NASDAQ, here's the QQQ, the largest traded ETF in that space. What do we know? That it gave you the first signal to start buying in here. If you can imagine, what other report, what other signal you had would tell you to start buying into this position? If you missed that move, you told you to start buying again here all the way up to there, and we'll let you know when to start cutting those positions back and taking a profit. Here you can see back to our January 9th report. Here we saw the machine position start to short cover, meaning they were buying off that big short position, telling us a reversal was starting to begin, giving you the indicator to start taking positions on the long side. Here again, we saw it in March 15th. Again, the machine started buying back again after that rally, again telling you everything you needed to know to start taking positions to the upside. It's $30 a month, link in the description below. Because the problems facing the banks, well, now as we dig a little bit deeper, we can see the problems are very obvious. Here we have the yield curve, one of our favorite things on this show. As you note, the 10-year, 2-year, which is the 10-year yield less the 2-year treasury yield. When that blue line goes below the black line, it tells us it's inverted. That's usually a sign of financial stress. And then when it skyrockets out of that inversion, it usually tells us we're headed into a massive recession or potential financial crisis. But I'm going to change the delinquency rate because I want you to see this. Instead of just showing you as a percent, we're going to put it on a year-over-year rate of change, because what I want you to see is when you have these deep inversions, notice how that steepens, and the delinquency rate, again, the rate of change, this is a little different. The rate of change goes up. You'll notice here going into the global financial crisis, you note during the pandemic, again, on the other chart, there was barely a blip, but the key part is the rate of change. And look at it now. We're already seeing that rate of change move higher before the yield curve even started inverting, telling us that there's already problems here in the banking system. Obviously, we knew this, but the issue we face here is that the rate of change now is moving up off very low levels, and sometimes it takes just a little spark to trigger a forest fire. This one, once the commercial real estate market goes, watch out, these small banks are going to be in big trouble. And here's the evidence that the problems are maybe even worse than we thought. The 500 billion office real estate apocalypse, this from Fortune magazine. Researchers find remote work's efforts even worse than expected. So you can kind of go back to prior cycles, and we didn't have this kind of work from home or hybrid work schedule movement, and now all of a sudden it's very popular. A lot of companies are doing it, and that in itself could have led to a commercial real estate crisis. You talk about, on top of that, you have banks tightening lending standards, you have the Fed raising rates. What we have here is an issue. We have a lot of supply, we have a whole bunch of buildings, and a huge lack of demand. In a paper published last year, researchers from New York University and Columbia University estimated a decline in New York office values. Are now revising that, saying they now see a 44% decline. Now, this is just in New York City, not to mention the rest of the country. They think a 44% decline in New York City office values by 2029, and a nationwide value destruction in the $506 billion range in just the 3-year period from 2019 to 2022. So they're saying, these buildings are going to lose value. You look at who's holding the mortgage on these, and that is, of course, a lot of those small banks, almost to the tune of about $2 trillion. So you put this in perspective, the people that own these buildings, the companies that are buying them and leasing them out, what they do is they put firewalls around them. They'll put them in separately held LLCs or corporate entities, so that way if they default on one, it doesn't ruin their whole portfolio. Of course, what you might be surprised to know is that banks are totally okay with this. They still lend to it, even though they know if things go bad, it's real easy for these companies to mail these keys to these office buildings back and let these banks hemorrhage and fail. The key takeaway from our analysis is that remote work is shaping up to massively disrupt the value of commercial office real estate in the short and medium term. No surprise, may go longer than that. Of course, my argument is during the next recession, you're going to see a big push to get people back to the office, because when people go to work, they drive their car, they go to breakfast, they get coffee, they go out to lunch, they buy clothes, they spend money, and those are things that drive the economy on top of a whole host of other things. And if that goes back into effect, then what you're going to see is businesses that have failed come back into place. Businesses that need revenue are going to start seeing it, and you're going to watch. The government is going to push for people to go back to work. I'd love to hear what you think. Do you think that's going to happen or not? The ticking time bomb in America's downturn, the sad state of office buildings, could cause something called the doom loop. There are 3 separate reasons commercial real estate is being pummeled. First, it's highly leveraged, or in plain English, landlords usually borrow most of the money they need to buy their properties. So kind of unlike a traditional mortgage where people are incentivized to put 20% down, in the commercial real estate space, you're not really incentivized to put a lot of money down, because the belief is the value of the buildings don't go down, and that is a problem. We've seen this in past crises, and this is happening again. The banks are lending on assets that they believe cannot go down in value, or if they do, only go down a small amount, and at that point they still have enough margin on the loan. But this time, with a hybrid work schedule, I don't think that's going to happen. I think prices are coming down. Second, interest rates have risen significantly, which means getting a loan has become much more expensive than it was 5 years ago, as owners typically refinance the loans that are in the debt wall, which is about a 5-year position that they hold them for, and that's going to be a pricey proposition this year. Selling is no longer easier. Buyers will have the trouble borrowing money, because who wants to buy a building right now when they're hardly occupied, and more companies are moving away from office space? You start to put this all together, and you see why that a collapse in prices has to happen to bring rents down enough to get companies to go back to work. That's really the key thing we're looking at here. Third, those rising interest rates are not associated with a strong demand as they've been in the past. This is something my friend Jeff Snyder and I talk about all the time on his show. Check out his YouTube channel, Eurodollar University, because when the economy is strong and booming, there should be a demand for money, and that means rates rise. But when you see central banks forcing rates higher, it's all for the wrong reasons. But speaking of central bankers, are they about to stop raising rates? Well, the IMF says you better not. IMF warns of prolonged high interest rates, urges financial tightening to tackle inflation. In a recent statement following its comprehensive assessment of U.S. policies, the IMF emphasized the need for the United States to maintain higher interest rates for an extended period to curb inflation. And yet, as we've talked about on the show, the yield curve is telling us they don't need to maintain higher rates. They need to be cutting rates, because if they don't start cutting rates soon, something is going to break in the system, and you're going to watch the Fed's going to be back at zero faster than you can blink. And I know many of you disagree with that, but watch and see. They're going back down in a big way really fast. And despite the U.S. economy demonstrating resilience in the face of tighter monetary and fiscal policy, the IMF noted that inflation has proved more persistent than initially anticipated, because in the fantasy world of that as central bankers, they expected inflation to come straight down. But when you look at inflation, the CPI, it's a lagging indicator. It takes time for all of the inflationary things to feed through the system before they calm down. And now what we're seeing is impatient central bankers, leading to more rate hikes, which is only putting more stress on the banks at a time that they don't need more stress, because all of these commercial real estate loans are going to start coming due this year. The international organization warned because of these factors, monetary policy may need to get even tighter than today's already restrictive levels. This creates a material risk that the Federal Reserve will have to raise the policy rate by significantly more than is expected to return inflation to 2%. Well, my friends, you want to have inflation return to 2% in a really fast way? Well, one good way to do that is to have a banking crisis, and you'll watch. Inflation will get to 2% and then plummet into deflation. You almost wonder if these central bankers have any clue what they're doing. And here we can see, of course, the yield curve. We're coming back to it against the net percentage of banks tightening lending standards. That chart still in blue. Of course, we know if the Fed and other central bankers further tighten rates, they're going to further invert the curve. And what do we know? That when they do that, it forces banks to tighten lending standards, because as we've talked about on the show, banks borrow at the short end, lend at the long end, puts them in a precarious situation here. And all it's going to do is lead to another crisis. But one crisis now that appears to be averted is the debt ceiling. As debt deals economic hit seems rippling through 2024 presidential race, this threatening to hurt the economy during Biden's potential re-election coming then. As the contour of the economic impact of a spending cut deal is such that the most of the hit will happen in 2024 when the cap is removed. If that's 2026 or 2025, then whoever wins the 2024 election will likely have a strong recovery in that administration. And what I want you to note here is that what we're seeing is, again, political gamesmanship to take the White House back. Of course, we know that that's what Republicans want. We know Democrats want to keep it. But here's the key thing I want you to take away from this is we already now are potentially going to have spending cuts already lined up as we head into recession and another financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.